Now, with today's IPO, Uber's market value is just below $70 billion, certainly enough to qualify it to join the Standard & Poor's 500 index. However, you won't find it there anytime soon. Mike Santoli explains why.
Uber made its long-awaited public debut Friday as one of the 100 or so most highly valued companies in the stock market. But it's not clear when or whether Uber might find its way into the market's key index, the S&P 500, or into the trillions of dollars worth of funds that track it. At its initial valuation above $80 billion, Uber is more than 10 times the minimum size to gain entry into the S&P 500. But the index keepers at Dow Jones S&P indexes require that the member companies report at least 4 quarters of profits using standard accounting measures to be considered for membership. Like many fast-growing Silicon Valley tech giants, Uber has never earned an annual profit, and analysts don't expect it to in the next couple of years. Like its smaller rival Lyft, Uber is investing heavily to recruit drivers and sign up new customers while subsidizing the cost of rides. It's common for new IPOs to wait years before joining the S&P 500 if they ever get in there at all. What's unusual in today's market is the vast size of the established tech companies that are coming public after years in business with billions in revenue but no clear path to profitability. Following Uber's IPO, aggressive office-sharing startup WeWork is planning to come public while still deeply unprofitable as well. This will leave a fairly large amount of market value assigned to emerging disruptive tech giants, but not reflected in the market benchmark and not owned by low-cost index mutual funds and ETFs that have become, by a large margin, the most popular investment vehicle for retail investors. Whether their absence from the S&P 500 is a good or bad thing for index fund investors won't be clear until the market renders its verdict on the long-term value of Uber and its peers. For Nightly Business Report, I'm Mike Santoli.